G'day guys, Ben and Simon from Pumped on Property here doing one of my favourite things to do each month, which is our market update. Now in today's market update, we're going to be talking about some of the good stuff from CBA, the Reserve Bank, CoreLogic, as well as a whole lot of our other favourite analysts. But what are CBA saying this month, bro?
Look, it's a story of two things at the moment. You've got the narrative from the major media outlets at the moment and the data coming through from the likes of CBA, SQM, CoreLogic, which we'll go through as we can today. So recording this video on the 6th of July, we've just had a pause in interest rates, which actually was predicted by CBA a couple of weeks ago, which is nice to see. They might expect one more rate rise at some point over the next couple of months, but they expect us to be extremely close to the top of that interest rate rising cycle. Now, the better news coming out of CBA is what's expected to happen later this year and then into 2024, where they expect rates to potentially drop the cash rate by about 1.25%, which I know I would love. Paying a lot of money to interest in the banks at the moment with those higher rates for sure. But the email that we just got from Property Share Market Economics made me super happy. So what are the guys over at PSE and Phil Anderson saying?
According to Phil, and I'm excited because Akil, one of the guys over there, is about to release his new book. It's about 2 weeks away, looking at long-term real estate cycles. I can't wait to read it, but most importantly, how to invest our money at different stages of the cycle to protect ourselves, to reduce our risk, and to improve our chances of gains. So I'm excited for that one to come out soon, but Phil still believes that the cycle's very much on track. He's not seeing anything that's making him feel any different at the moment. According to Phil, we've just moved to 2 o'clock on his property clock, and that's around about the lavish government spending time, which I think off camera we're just talking about how much money the Australian government is spending at the moment to the big four consultancies, let alone everybody else. It's just billions of dollars a year at the moment. There's the COVID bailout plan in terms of the infrastructure, with most of that stuff just coming through now. So between now and 2026, there's literally billions and billions of dollars of projects in the works, employing hundreds of thousands of people and all the private businesses as well.
And as we know, Australia's just a drop in the pond, essentially, when it comes to the global economy that Phil really subscribes to as well. And yes, we're spending, tens, if not hundreds of billions of dollars here locally, but overseas, trillions and trillions of dollars being spent from these developing nations, getting loans from some of the bigger nations like the US, Europe, and China.
Now, if we look at CoreLogic, national values are up for the fourth consecutive month in a row, in June rising by about 1.1%. And from the bottom of the house declines until now, nationally we're up about 3.4%. So things seem to be heading in a positive direction, with Sydney and Brisbane leading the way at the moment.
Yeah, Sydney's up something like over 6% in this current growth cycle over the last sort of 4 months. Brisbane up over 3% as well, so both of them leading it. Now, I want to talk a bit more about SQM Research. They produce some amazing information about the listings that are on the market, the vacancy rates, the rental returns, asking prices, all of these things. Now, vacancy rates are still super low levels, between about 1.1 to 1.2% nationally at the moment. So significant undersupply of rental properties. Less than 40,000 vacant dwellings are available around Australia at the moment. So something needs to change there. It's looking like those vacancy rates are starting to track upwards, but really, really slow at the moment.
And anything below 2% would be classified as completely undersupplied. I've bought suburbs before where it only takes me 2 weeks to rent a property when the vacancy rates are as high as 3%. So we're so far away from there being an oversupply. In fact, I heard with the number of students coming in, the number of international students coming in, according to the ABS, we could build so many more dwellings every year for the next 10 years and not even touch the sides on it. So there's a lot more needed to be done with planning, with fast tracking development and approvals.
Now, one of the major reasons for property values rising, according to CoreLogic, is just the undersupply of properties available to purchase or to build. Now, looking at that, it is changing and those listing numbers are slowly starting to track up. Now, in June of 2022, we saw around 220,000 listings on the market, but now in June of 2023, there's around 230,000. So that is a good thing. I know for us as buyers agents, it has been quite tricky to find quality properties with this undersupply. So that's a really amazing thing. But what I loved out of SQM is their data on the distressed listings, because we've been hearing about this mortgage rate cliff in the media at the moment. You know, it started in Feb, then it got pushed to April, then it got pushed to June. Now they're pushing it to September, and probably by September they'll push it to December. But statistically speaking, and when you look at the number of distressed listings on the market, it's declined year on year. In June of 2022, there was over 6,000 distressed listings on the market, but as of June 2023, there's just over 5,000 distressed listings on the market, which is a very small percentage of the 230,000 dwellings available on the market, and about 11% drop in distressed listings over the last 12 months. Now, if you're not already, subscribe to these guys, subscribe to Property Share Market Economics, subscribe to CoreLogic RP Data, to SQM, because all of them are producing in real-time data as to what's actually happening. So for me, I don't have to watch the news. I can just jump onto these articles and look at actually what's going on. But there's a guy that I subscribe to, and I absolutely love him, and his name's Michael Matusik. He's an Australian investor and analyst, and he produces some of the most entertaining articles that I read on a monthly basis. So I really appreciate your, communication style and the way that you just say it how it is. And he's coming out with some brutal articles in recent times talking about house prices, talking about the economy, talking about the undersupply of dwellings at the moment. And in his most recent one, he was talking about unemployment and inflation. And essentially what he said is the RBA is trying to push up the unemployment rate, because right now we're sitting at about 3.6%. But for the RBA to get inflation at the target 2 to 3% range, they feel as though that unemployment rate needs to be about 4.5%, which means over 140,000 Australians losing their full-time job. That's pretty rough to think.
Absolutely brutal when you say that.
It's really, really sad to think that 140,000 families are going to lose their jobs to get to target inflation. I get it. Like, inflation sucks. Like, I hate the fact that fuel's going up, food's going up, my electricity bills have gone up, my water bills have gone up. Everything's going up, but it's in these fixed costs, right? That was another thing that Michael went into saying, is like a lot of the inflation is being driven by those costs that you can't get away from. You can't not buy food. Most of us need fuel in our cars to get to work. And, we all need power in our homes so that we can live. And, all of the discretionary spending costs, that's actually been dropping quite substantially recently.
To wrap it up, we love looking at what the RBA is saying at the moment, and they have done a very, very tricky job in the last year, like with all the government money that was printed out of thin air, and the fact that we couldn't spend it for years and years and years and stacked it in our bank accounts, and then went and sprayed it on building and cars and caravans. Renovation, all the stuff, and now travel again for a lot of people. I get how hard the job has been, but the RBA from, the peak rate was up to 8.4%, and they've got it back according to their latest data for like the year ending June 30 to about 5.6%. So hard job to have, especially when the UK is out of control right now. Disruption in Russia, disruption in China, a lot going on in America. But I have heard through the grapevine that lending's starting to continue, building starting to commence in America, and property prices in many places are starting their upward trend. I've noticed stock markets seem to be recovering and pricing in where they think the market will be 9 months from now. And I'm not a crypto guy, but even crypto looks like it's had a pretty bloody good run in the last time too.
Yeah, well, I can talk to that because there's another guy that I subscribe to, but we don't talk about it too much because it's all about the US. But the US leads this cycle, so I want to make sure I know what's going on over there. It's Daily Briefs from Jaspreet Singh. Epic read. He looks into the stock market, the real estate market, the crypto market, and he just looks at whatever is going on around the globe at any given time. And, since the start of this year, really, like everything has been improving. Like, some tech stocks are up over 80% this year. Crypto's up over 60% this year for the big ones. Real estate's starting to bounce back and people are starting to transact a lot more. Values in certain cities in the United States are starting to move forward. What a lot of these guys are saying that we've basically seen a bottom and now we're moving into more bullish conditions. Now, obviously nobody can predict the future. Nobody truly knows what's coming next, but there is a lot of optimistic analysts and investors out there at the moment.
When I think about this in reality, there's been many people sitting on the sidelines since the GFC freaking out. And then a few people came back into the market, speculated, got heavily burnt during COVID, tried to speculate a little bit more. And then the Reserve Bank and globally inflation kicked in and, they've tried to suck the money out of the bank accounts. So what I am seeing personally is like more and more and more tension on the system. And at some point, people are just going to go, fuck it. I want to travel. I want to spend some of my money. And most importantly, I want to invest in my future because I've had my head in the sand for between 4 to sort of 12 years now. And what that normally creates is monster amounts of momentum at this stage of the cycle. If you look at the last 3 or 4 years leading into the last GFC in Brisbane and Perth, house prices in both of those markets went up way more than 50% basically. So there's potentially some big stuff coming. If you look at the indexes in the Australian or the American stock markets in the last 3 years leading up to the last GFC or 4, like in some instances doubled. If you look at gold in the 18 months leading up to it and silver, prices more than doubled as well. So don't expect the wake that we're in at the moment, which is the devastation from the last 4 to 10 years, to be like the position as you project forward, because things are turning very, very quickly, which is why I've changed from sitting on the fence this year to releasing equity, to seriously looking at the market, to absolutely going out there and buying again soon, because I know when the market finally gets stability for the first time in 3.5 years, which we haven't had, and interest rates, if they come down, I've looked at 60 years of that data now, and I can tell you something good's coming.
Now, I know we do have a far more optimistic view of the not too distant future. Look, it's just who we are as people. And when you look at some of the data and when you look at some of the fundamentals, they do look great. But at the end of the day, we just want to provide you with this information, with the data that we're seeing, so you can make a more informed and educated decision. So we'd love you to share this video with somebody that you feel as though needs to hear it at the moment, or somebody that you feel as though could learn a lot from this video. And if you haven't already done so, guys, please subscribe to our YouTube channel. Give us a thumbs up.
Woo! That's a wrap.
That's a wrap.
Getting
Have a
full,
spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
Very nice, eh?
Oh.